that we took down last year got us over 900,000 in tax savings. Our current opportunity is offering around a 50% return on your money through your taxes. So if you invest $100,000, our preliminary cost segregation study shows that you will get 50,000 of that back your first year in the investment. So Pine Tree Path, from a high level, this is outside of Lexington, Kentucky, in Georgetown. It's an absolutely beautiful brick building. 72 units. This is going to offer up to an 18% internal rate of return. Our exit multiple on this, we're planning for a 2.0 exit multiple. So 100K in equals 200K out. Great building. We will talk a little bit more about it. If you're interested in talking to us more, Sue is on here with me. Sue, if you want to make sure we get the link in the chat, you can book a call either with myself or with Sue. We'd be happy to talk to you about it. This is for accredited investors. We do have some other investments for non-accredited investors. So if you're looking for a great place to park your money, get a phenomenal return in a passive manner, reach out, click that link. You'll get on with either myself or Sue. We'd be happy to walk you through the deal. It's called Pine Tree Path. All right, Nate, you got reconnected. Bring you back up. All right. We're going to go ahead and jump into the news because we have so many stories, so many things going on in our world. The first thing that I want to put up, let me pull this one over. The first thing that I want to pull up is, where's my tab? Here we go. This one is 5 signs that we are in a bubble. This one, the one that I pulled up was actually the JP Morgan Chase. So maybe we'll start with that one. This one shows that JP Morgan Chase just wrote off a staggering amount of money. Nate, what does it mean when banks write off money? This is 3.5 billion.
Yeah, this is a 70% surge in write-offs for the 2 largest banks in America. So let me put that in perspective. A year ago, we weren't having these conversations. A year ago, everyone was saying there's no softening in the economy. Nothing's going wrong. Employment's strong. Banks are strong. Well, here a year later, we're finding out the truth. The truth is that right now the people are not paying their credit card bills, and the bank is trying to collect on them, but they've gotten so tired of trying to collect that they've given up. They've given up to the point now where they're writing off the bad debt. And so when you see this huge numbers coming out of JP Morgan Chase and Wells Fargo, and you know that it's a 70% jump quarter over quarter, you just know what's actually going on behind the scenes. People are stretched. They're very stretched. All that extra COVID money that they had sitting and they were banking on, they spent that. Now they've dipped into credit card debt and they're not repaying their credit card debt. So I'm not trying to give like doom and gloom for everybody, but I want everyone to know the reality that the economy is going to go through a little bit of a phase for a bit. This is usually when the best real estate deals emerge, and we're starting to see that now anyways. But we have to understand where the real economy is at. The average consumer is struggling today.
Okay, so speaking of where the economy is at, I'm going to bring this next tab over. Hang on one second. It's giving me a hard time getting it up. So the next one that we have is what's going on in the stock market. So in the stock market right now, you might have noticed like it was kind of flat for a little while, and now we're seeing this like small surge. What does that actually mean? Like what is happening in the market? And it's that stocks right now are being held up by just 5 tech stocks. Nate, I don't know if you're able to get it up. When I pull it up, it takes me to a ad block page.
Yeah, is this the Yahoo Finance article?
Yeah.
Okay, so I'll pop it up on the screen for everybody. And Steve, I'm gonna have to take over your screen for a second.
Yeah, there you go.
So here's what you want to know on this. The market right now, stocks in particular, if you look at the S&P 500, that's where most people put their money into index funds like that. S&P 500, biggest companies in the United States of America, are biggest companies worldwide that make the S&P list. There's only 5 of them that are pulling the weight right now. Like when you see positive numbers overall in the S&P 500, if you take out Nvidia, chipmaker, if you take out Facebook, if you take out Google, if you take out the 5 biggest tech stocks, all of a sudden now the rest of the S&P 500 is starting to pull break even or negative. That's a scary stat. We've never been in this territory before. So the fact that right now everything is floating off those 5 companies in the entire S&P 500, it's something that, at least if it were me, I don't invest in the stock market anymore. I watched my 401k get cut in half more than a decade ago. If it were me, I would be very cautious about leaving money in the stock market right now. I'm not trying to give doom and gloom, and I'm not a financial advisor, so I can't give you advice like that, but I would definitely just be very cognizant of where the market's at. Right now, it's being propped up by 5 tech companies. If any of those 5 start to have bad performance, S&P 500 as a whole will come down.
That's like, it's interesting. I had this discussion. It was actually, we were talking about it Saturday morning, I think at breakfast. We were going through what was going on with the stocks. And I would agree, like, it's hard not to be like, oh, but look, they're going up. But it is all based on just a very few tech stocks of all things. Going back to what's going on in the market, we watch auto loan repos, we watch credit card defaults, both of which are at an all-time high right now. They've been climbing and climbing and climbing. That kind of shows you where the economy is at behind the scenes. So what does this mean for real estate? We're going to start off with single family, and we've got a couple different articles here for this one. This article right here shows five different housing types that are expected to plummet by the end of the year. We've already seen this quite a bit. A lot of you guys know that I live in Austin, except during the summer when it's just too hot to be there. Austin's seen a huge surge, a lot more inventory, and they've seen a lot of houses, especially luxury houses, drop in value. So this one's showing 5 types of houses that are expected to plummet by the end of this year. Right at the top, you see urban apartments and condos. Then you see older suburban homes. And then you see luxury properties. Nate, what do you think about this?
Yeah, it follows the cycle of every downturn in real estate. So you can expect, this is the bottom line for this whole article, you can expect that condos will be first on the chopping block. Condos will lose the most value the fastest. Townhomes are always second in line, and then older suburban type communities. That's typically how it goes. The one that might surprise a lot of our viewers, because we have a lot of viewers that own these, is luxury properties. So luxury properties are on the list. And what happens is that newer communities tend to grab the attention. And so if you've got an older luxury property, a lot of times they start to deflate a little bit during cycles like this. So if you've got any one of the 5 that we mentioned right there, you might want to look at a potential exit on the property, unless you just plan to hold long-term. If you don't care what the market does, cool, keep it. But if you've got it as an investment property and you intended to sell in the next 3 or 4 years, today might be a good chance just to exit on that property.
Yeah, this goes back to the bubble that we were talking about, but for sale signs are becoming more and more common as a surge in new home construction has collided with cooling demand. What happens when you end up with builders that have been building, and then you end up with a lot of people putting their property on the market, not being able to sell? You end up with a really stagnant market. And you're seeing a lot of this across the US. It's been growing. If you guys have been tuning into the show, every week it gets a little bit more and a little bit more. We're seeing this grow quite a bit. Nate, what do you think about new builds right now?
I think it really depends. Like if someone's going to build it as a personal house and they don't care about selling it in the next handful of years, totally fine. If someone's taking out a construction loan, I would be cautious. Lenders tend to freeze projects in the middle when they start getting hurt too much. So I'd be cautious on that frontier. It depends.
Yeah. I want to show this because this article caught my eye, and I think that it's worth talking about here. So what is absorption rate? Multifamily absorption rate has reached its record high in Q2. So what is absorption rate? This kind of has to do with building and what's going on in the rental markets right now, which is going to lead us into the Biden piece.
So absorption, literally, if you think of a sponge absorbing water, when they use that term in the multifamily real estate world, what they're saying is new units that come to the market, they need to be absorbed by the market, much like a sponge would absorb water. And so what they're talking about here is all the new construction units that have been delivered. And you're seeing a lot of them come out right now because they started 2 years ago. A multifamily project takes about 2 years from start to finish to come on live as a rentable unit. So interest rates were low 2 years ago. Builders were going crazy building them. Now, with high interest rates in this environment today, they're not building very many right now. They've pretty much seized all new construction. But we still have to absorb everything that started a year or two ago. And everyone was panicking, saying, oh my goodness, the market's not going to absorb that many units. There's no way. Rents are going to drop. But what this article is showing right here is that the absorption rate just hit a new record high. The units are being absorbed. And if you think about it, I'm not going to get into like the numbers because I don't know the numbers, but we have a lot of immigrants that have come to this country in the last year and a half, 2 years. Millions, some estimate over 11 million. What kind of housing stock do they typically go to? A lot of them end up in multifamily. And so consequently, we are short. We were short before immigrants came to the country 2 years ago, and we're short today. We're going to be short next year. We're going to be short the year after. So I think that this absorption rate is just a reality of the marketplace. Multifamily needs more units. They need them really, really bad. So it's going to continue to drag rents up right now.
So it should push rents up, but we just saw, like today, we saw where the Biden administration is recommending rent control and is going to push for rent control. I don't know if I can get that off of the screen. There we go. So annoying. The Washington Post is the article that we picked for this. Nate, do you want to talk about rent control and what you think of this?
Yeah, without getting banned from social media platforms, I'll do my best. Last time I talked about rent controls, TikTok gave me a slap and I got slapped on a few other platforms too. So I'm going to do it in a politically correct manner, but I'm going to try to speak truth anyways. So rent control, what that is when the government comes in and says, you can't raise rents or you're limited on the amounts that you can raise rents. You're capped at this level. That's rent control. And it's an amazing campaign promise for political candidates because they get a lot of people that say, oh yeah, take away those greedy landlord profits, strip them away. So it becomes this rally cry during political candidacy. We saw Biden come out actually when he was running for his current term that he's serving right now. And he said he was going to eliminate the 1031 loophole, which is a real estate tax incentive for us real estate investors. He was going to eliminate basically three things under the reign of real estate tax incentives. Well, when he brought those to Congress, guess what happened? If you guys know, put it in the comments, put it in the chat. He brought them to Congress, and Congress happens to be filled with a whole bunch of people that own real estate. And that got shot down really fast. So the 1031, we still have it today, even though that was a campaign promise that from the Biden administration. They didn't get anywhere with it. And my suspicion is that this whole last ditch effort, this is kind of one thing that he's trying to use to gain some more votes coming into the fall election. It's going to get shot down as soon as it gets to Congress as well. I know the Senate would never approve this. At least that's my humble opinion. I don't think the House would approve it either. So I don't think it's going anywhere. Nationwide rent control, it's never worked on scale anywhere in the United States or anywhere in the world.
I mean, first off, I think this is a play just to get some coverage and try to get some votes. It's an interesting try because I think I agree with you. Like something, I'm trying to remember the stat that I read. It was something around 70 to 80% of people that are in political offices own real estate as their vehicle of wealth. They're not going to let any of this take over, but they have to put on a good face for it. What do you think we're actually going to see happen? You think we'll just see this in the news and then it will fade away?
Yeah, I mean, what the student loan debt cancellation that got shot down across the board. It ended up going to the Supreme Court and getting shut down. But then Biden found another way to get part of it done through an executive order. So could we see something like that for the last 3 or 4 months of his this term that he's serving? It's potential. It's a potential. I don't see it happening. I really don't. There's too many people in office right now that own real estate. It is their vehicle of wealth, as you said. I don't see it getting anywhere, but it's going to dominate the headlines. It's going to make people go into fear mode and say, well, hold on, maybe I shouldn't invest in real estate because they're going to do rent control nationwide. So it's going to scare people. So the benefit for us as savvy real estate investors is to say, well, odds are that's never going to happen. So while everybody else sits on the sideline and panics, we're going to keep buying. I'll tell you what Blackstone's doing right now. John Gray from Blackstone, he spent 20 billion buying multifamily the last 3 months. Why would the world's largest landlord continue to take action? He's got insider information on this. Like Biden came out and on a press conference and said this today. We knew about this more than a week ago. And that's why we're reporting it to you guys right now. We knew about this before it ever became mainstream. I know that Blackstone knows this stuff before Biden opens his mouth and talks about it. So Blackstone has no fear. They bought 20 billion in multifamily. I don't think this has a chance of ever touching or becoming legislation.
I would agree. If you're listening to this and you're like, well, maybe I shouldn't invest, or maybe I should sit on the sidelines for a little bit. Let's actually talk about, Nate, what like you just said, like creates a huge opportunity because some people will stop buying. What would you say if people are worried about it? Is there anything?
Well, first and foremost, there with every law that's ever passed, there's always smart people that look at it and say, okay, how do we still honor the integrity of the law but not get hit by the law? How do we work around this? And I'll tell you, we've gone through, we did this just as kind of a preemptive move, just in case there's a slight chance that it gets through. And we went through documents, pages and pages, case studies from around the world of where rent control was passed. And I won't bore you with this whole 52-page article, but what some people have done is if they do have property that gets caught in a rent control environment, like Portland, Oregon did it as an example. New York did it in a sector of their city as an example. What those building owners did is that rather than being forced to cap their own rents, they made their building into condos and they sold the units at a higher premium. So they made bigger profit on it. So my point is that there's moves that you can make even if something like that came down. You're not just going to sit still and the real estate's not going to go to zero in value. It just adds an inconvenience to the whole investment on your business plan. But again, Steve, I think it's all just political jargon. It's talk to buy votes right before the big election.
Yeah, I think that's it. I mean, they're just looking for things to get out, to get votes, to grab some attention, and have people start to notice them, right? To pay attention. How can I make a grab for attention? That's really what a lot of the political game is, sadly. All right. So with all of that being said, that's what's going on in the US. Let's talk for just a second about what's going on internationally. Why? Because usually the US leads and then the rest of the world follows. We've seen some things in China with the Evergrande debacle. But right now we see some stuff going on in the EU. Nate, I don't know if you can pull that one up if you have it handy. If not, I can grab it.
Yeah. Yeah, I got it here. This is the biggest landlord in the European Union. He happens to be the owner of a German fund, and they've invested a ton in Sweden, a ton in Ireland, a ton in Germany, all over Europe. And he's coming out right now saying there's going to be bankruptcies. There's going to be a lot of real estate projects in Europe that go bankrupt. And he's saying it based on his inside information, and he plans to capitalize on it and buy a lot of those. But he's basically saying Europe has started its downfall with some of the real estate projects. So as Steve said earlier, you said United States usually leads and then the rest of the world tends to follow. Well, we saw our downfall of office space starting 2 years ago. We saw multifamily come down just the end of last year. Multifamily, for the first time since 2009, had its dip and it came down, and we happen to be in that dip cycle right now. Well, it's happening now in Europe too. They're following.
Yeah. So not just Europe, let's talk about Canada too, our neighbors to the north. Sadly, they are starting to see their market fall down by almost 10% right now, year over year. Nate, I don't know if you can grab that one real quick. I love
Yeah, I got it
Canada.
right here.
I like our cousins to the north, and I definitely feel for them, but it's starting to affect them up there as well. Um, Nate, between EU and Canada being down, what does that mean for people in the US? Like, are there still opportunities here? Should they hold their money? What do you think this means for people in the US? What should we be paying attention
This
to?
this is opportunity of a lifetime. If someone would have told me, like I was in the game, you were in the game during the last correction, 2008, 2009, 2010, I was in the game, but I didn't know what was going on. I didn't understand the magnitude of buying a property. Like I bought 1104 Cook Avenue East, a little single family in St. Paul. I bought it for 22 grand. If you go into Zillow today, it's worth 236,000. That's like 14, 15 years later. Imagine like if someone would have whispered in my ear back then, Nate, this property that you're buying for 22 grand is going to go up 10x over the next 15 years. I would have bought 10,000 of them. I would have found a way to get enough money to buy 10,000 of them, and I would have kept them all. I didn't know that. Consequently, we ended up buying a few hundred, and God blessed us. We did well with them. But now I know and I understand these market cycles very well. And when I see this dip right here, this is multifamily. Okay, single family, we haven't seen it yet. Okay, I haven't seen it yet because it's being propped up by what the government's doing to single family to prop it up. We can talk about that a little bit later. But multifamily, we saw this dip in 2009, and now we see a dip again right here. This is the first time since 2009 we're seeing the dip. When I see a dip like this, I'm all in. I'm going after it. I will not repeat buying too little during a down cycle because I know that this is when most of the money is made. So yes, there's going to be fear. There's going to be statements out there. There's going to be companies going bankrupt. There's going to be unemployment rates going up. All of that bad stuff will dominate the headlines. But the smart money right now is buying really good multifamily real estate.
Speaking of really good multifamily real estate, Nate, that's Ironwood. That's not what I wanted to share. That was one of our past deals that did amazing. Let me find, let's try to pull up our current deal. Our current deal is called Pine Tree Path. Nate's got it. There we go.
Yeah. Pine Tree Path. This is an absolute winner. So those of you guys that have been hanging with us and following us for a while, you know that the last 6 months we did not bring any multifamily property to you guys. We didn't because we were waiting. We were being patient for the really, really good deal. We bought a lot. We bought over 1,400 buildings in our lifetime. And but we've been patient during this cycle because we wanted to get the right one. And thank God this one came. It fell into our lap. 2 years of negotiating with the seller on it. Beautiful brick building, 72 units, off market. Nobody in the world knows about it except for us. And we negotiated with the seller so long and so hard that the seller agreed to do 4% seller financing. So the majority of the property, the seller believes in so much that they were willing to leave their money in the deal, which never happens. It's very rare to get them to do that at 4% interest. So the play on this one, it's really simple. I'll put it right here. This will be a highlight for you. We're buying it right now, and it's leased way under market value. It's leased at $1.19 per square foot. Market comps in the area are $1.57 per square foot. You can see right there. I'm happy to share this whole document with you. You can see all the comps, all the buildings, but the seller currently has 100% occupancy with a waiting list. They have not pressed rents at all. There is huge upside for us to come in and press this to market value. What does that do for us? Well, that lifts our valuation so much that we're able to, our projected IRR for investors is 18%. So coming in a deal like this, basically you put in 100 grand, we can pay up to $18,000 on that 100 per year that the money's invested. It's a really, really killer deal. We don't see them like this very often. I wish we would have had like 10 of these this year, but this is the very first one of this year. If you're interested in investing with us, all you have to do is book a call with us, 15-minute phone call. We'll go through the details of the deal. We'll answer any questions that you have. We don't do any like sales or hard pressure stuff at all. We want folks that are good long-term partners that we can get into a deal with, we can shake hands and everybody can win together on. If that's interesting to you, then use the link that Sue dropped in the chat. Sue is our partner. She's been with us for a long time. She's invested over $1 million of her personal money into deals. Steve and I invest into our deals as well. I have money going to this deal like any other one that we bring forward. We want you to see that we're good with the deal as well. So that's the deal. That's the best one of the year so far, Steve.
Yeah, we'll be happy to go through it with you. You can book with myself or Sue. You can click the link that is in the chat. We're happy to talk to you about it. It offers, let's talk about the tax savings. So something that is very interesting to most of our investors is wiping out part of their W-2 income, part or all. We've actually been able to help several of our investors wipe out all of it. Nate, what does the cost segregation study say for this one? How much are we going to be able to save people?
Yeah, the prelim cost seg study. This sounds gibberish, I know. Let me break it down what that means. But the prelim study says that between 46 and 55% will be the tax incentives. What does that mean in English? I got a 10-year-old son. I try to speak to him in 10-year-old sons. When he buys real estate with me, I look at it and I say, hey, you buy this condo, you put in 100 grand, and the tax benefit for you is around 50 grand. That's how I try to sum it up for him. In real terms, what it means is that the government offers a tax break called passive losses. Write that one down. Remember it when you talk to your CPA. Passive losses. You invest in real estate, you get passive losses. It doesn't mean you physically lose money. It means that the government is giving a tax credit through something that's called depreciation. So what does that mean? We sent a specialist out to the property to go and size it up. And they came back with a report and said, hey, I would stand in front of an auditor to justify that if you put in $1, you can get about 50 cents back on the dollar in tax benefits. Now, there are some rules for that. You have to qualify. You have to do some certain things in your taxes. You have to make sure you check all the boxes. If you're interested in exploring what that could look like for you as a tax incentive, then what I would do is book the call with our team, because we would need to talk to you individually. I don't know your personal stance and how you file your taxes and all that kind of stuff. But if you jump on a quick call with us, we can certainly point you in the right direction. We can refer you to my CPA or Steve's CPA. We can make sure that you get the right advice to make sure you can pick up the tax benefits the right way as well.
Awesome. The tax savings by real estate is one of the most asked about pieces. I get people that ask me about it in person. I get some texts about it. This is a great deal for that. Just think about that. You're going to write a check for 100K, comes with up to an 18% internal rate of return. We're aiming for a 2.x multiple, which means you'll double your money within 3 to 5 years. Or I think we're saying 4 to 6 on this one. This one's going to take a little bit longer. And you get a massive tax savings on that money while it's there working for you. Again, if you want to book a call with us, you can click the link that is in the chat. Either Sue or myself would be happy to talk with you about this. This is for accredited investors, but we do have other investments for non-accredited investors as well. You can reach out, be happy to chat with you. All right, Nate, we wanted to add a little bit of teaching into the opportunity zone. So this week we wanted to talk about, we give a little bit for active and a little bit for passive investors if you are investing right now. Let's start with actually passive. We went through what's going on in the US, what's going on around the world. We talked about the absorption rate. If you are looking to get involved in a passive real estate deal, what are some of the things that you should look for location when it comes to the syndication that you're joining? Nate, I'm going to throw these out and we'll just kind of go through them. The first one, and probably one of the most important, is that it is in a landlord-friendly state. What does that look like? Let's lay out what a bad state looks like and what a good state looks like.
Yeah, bad. California. I'm so sorry. I know we have a lot of viewers from California. We have tons of investors from California. We will welcome you to the good part of the country for investments. I'm not saying California is bad to live per se, but from an investment standpoint, there's more risks. What are the risks? In a state that has a political environment that favors tenants or favors consumers over the business, sometimes laws can get passed, like rent control, as an example, or taxes can get bumped up. We saw in Atlanta, Georgia, the government ran a deficit in their budgets. And what did they do to make up for it? They doubled, in some case, tripled the taxes. So there are some states that are good and there's some states that are bad. We go for landlord friendly. So for us, one of those is Kentucky. It's been a red state, so to speak, for a long time. It's not to separate anybody politically, but what it means is that they're very business friendly. Kentucky has been rated in the top 5 business friendly states consistently for the last decade. Time and time again, people say, hey, you're looking for a business friendly state, you go to Kentucky. They've got a government that gets along with one another. They run a surplus budget and they're very landlord friendly. So look for states like that. You can also find them in Texas. You can find them in Florida. We like Kentucky because it's a little bit out of the radar of the Sun Belt, but that's landlord friendly. That's a good definition for it.
That's perfect. Then you touched on the next one, which is the surplus budget. So this is where Texas was all the rage for a while. A lot of people were saying, I want to invest in Texas. I want to invest in Texas. Now we saw Texas kind of got killed in the last year because they went and they had to change the way property tax was done. This hurt a lot of people who already had real estate going. And Nate touched on this, but you want to invest in a state that has a surplus budget. Texas did not. They were running a slight deficit. In order to make up for it, what did they do? They went in and they changed what taxes were. They changed them from the appraised value to the historic value, or the other way around. Sorry, I think I got that backward. They changed it from the historic value to the appraised value, which basically overnight tripled some people's real estate taxes, and a multifamily absolutely crushed it. The last piece that you want to talk about is the rent to income ratio. So this is something that you want to pay attention to. It's kind of why we wouldn't invest. I would never recommend investing in Austin a year and a half ago. Austin's rent to income ratio was way out of whack. People were spending 70% or more of their income on their rent, which one, can't survive forever, and two, when times get really tough, it leads to a lot of vacancies, which is what we've now seen in Austin. Rent to income in Kentucky is very, very good. It's one of the reasons that we love it there, kind of all across the Midwest. I don't know, Nate, if you have anything to add to the rent to income piece.
Yeah, it's interesting. We had a question come in from Cameron too. He's asking about Baltimore. We can kind of wrap that into this conversation. Rent to income is really, really good in most Midwestern markets, meaning it's cheap for them to live for their housing and their income, like it more than covers it. If you go to Miami, Florida right now, people are spending almost 50% of their income to afford a rental, depending on the zip code we're talking about. If you go to Silicon Valley, same thing. So you want to be in a good place that people can actually afford to pay for their rental dwelling that they're in. Baltimore, Maryland, I don't know where they stand. Oh, sorry, go ahead, Steve.
Oh, I went ahead and pulled it while you were talking. I went ahead and pulled the data. So average rent in Baltimore for a 3-2, 3-bedroom, 2-bathroom is $1,500 a month, just under $1,500 a month. Average income. So all we do is take that number, and now I'm going to plug in what is average income. Average income is a little bit low. It's a little bit lower than the national average at $36,000 per year. So they're spending a little bit above. They're at like 40%. If I'm doing the math right on that. Spending a little over 40% on their living. What does Dave Ramsey or any other financial guru pretty much say that you should spend on rent, Nate? Anyone in the chat want to guess? See if we can keep you guys awake. Ralph, you're not zooming anymore.
Yeah, man, I got it.
30% or less as a general rule of thumb. So when you're investing, when you're looking to invest, you want to kind of make sure that it falls within line or close to that. That's going to make sure that the people, if times get hard, they can still pay their rent, and you're not going to run into a lot of vacancies or have to take on tenants that you wouldn't want to take on.
So
all right,
Baltimore would disqualify from an income standpoint, and then additionally, it's been voted blue in that state, Democratic, since 1988, if I'm accurate on that. And so it's not a red state. Not the end of the world, but more than likely it's tenant friendly. More than likely the laws lean towards tenants. I've never owned in that state, so I can't speak firsthand, but when you have a Democrat state that's deep blue like that, usually the landlord laws are not favorable towards landlords.
Yeah. All right, so that's the passive side. If you're an active landlord and you're out there looking for properties, some of these things overlap, right? Landlord friendly state, you're still going to want to be in a landlord friendly state. Good rent to income ratio, definitely something you're going to want to pay attention to. But there's two others that you look at as a landlord as well. The first one is job growth versus unemployment. So why is this important? In Austin, I use Austin a lot because it was actually kind of the poster child for a bad place to invest for a little bit. The rent growth or job growth went straight up for a little while. They were off the charts, which seems like it would be a good thing. It pushes rents up, but what goes up really fast comes down really fast as well. And now that's what you're seeing. You want slow and steady job growth. This shows that people aren't moving out. People are still moving there. People are staying living there, and it's growing over time, but you're not having those big peaks, which then lead to big valleys. So that's one of the things that you definitely want to look for if you are doing this by yourself, if you're out being an active investor. One of the other things that I like to look for as an active investor, this was a conversation that I had on Saturday. Gentleman that is investing with us was talking about it. Investing in a place for cash flow, not just appreciation. I think a lot of people and active sometimes say, well, I'm investing, this is a great property and I'll make $100 a month right now on it, but down the road, I'll make more and more. Why don't we buy into that, Nate? Why do we want to see cash flow first before appreciation?
Yeah, you can't pay the bills off of appreciation, and the property is going to have expenses on the journey, and you got to service those expenses. And most people like to actually take dividends of some kind from the property. So yeah, you need cash flow for that. So we buy off of cash flow numbers.
Yeah, always buy off of cash flow. Sometimes it means you got to dig a little bit harder for a deal, but then that deal is going to end up serving you a lot better in the end. If you guys like this, if you always ever have questions, you can put them in the Facebook group. We're happy to chat with you there. We have a really active Facebook group, Partner with Home Invest. If you want to get there, some of you are watching this live stream in the group. If you ever have questions, put them in there. Nate and I try to be in there at least a couple times a week and answer questions. We've been getting more and more active in there. Feel free to post your questions there. If you would like to invest with us, if you're looking for a great place to passively invest, our passive investments usually return the same or better than an active investment for most people. You can click the link that Sue has put in the chat. Nate, do you want to go over Pine Tree one more time from a high level? This is a great investment, is the best thing that we have seen all year. We were pretty patient in making sure to take a great deal, up to a 50% tax advantage for people, as well as up to an 18% internal rate of return and a 2x multiple.
Yeah, I'll hit it really quick. And I did fail to mention this too. If any of you are working on a 1031 exchange, this is important. If you're in the middle of a 1031 exchange and you need a replacement property, this one could be a really, really good one for you. And here's why. Most groups that do partnerships like this on deals, they're really picky about their 1031 partners, because when a bank is involved to do the financing, the bank gets nitpicky. The bank wants to see so much extra paperwork, and a lot of times they won't approve a 1031 exchange partner. This particular deal doesn't have a bank. We are working with the seller directly. The seller is the one that's giving us financing at 4% interest. Therefore, it's easier to get a 1031 exchange deal done. One of the folks that's verbally been saying yes to this deal so far has $1 million on a 1031, and this one lined up perfectly for him because of that, because it's very friendly towards 1031 exchanges. So if that's a big thing for you, then know that this deal is a green light for 1031 exchanges. we can help you with that. We can't help on every property, but this one we can do 1031 exchanges on. Last big thing for us on this, Steve, if you're wondering like, well, hey, how do I know I can trust you guys to do this? We've been around for a long time. HomeInvest has a stellar reputation in the marketplace, over 1,400 deals, full cycle. You are direct to the source. You're not working with middlemen. There's no brokers here. I think that's important. When I invest passively into other people's deals, I always want to deal with the people directly. And our track record has been really good. Like we got to take this property. This is a 20-unit building that we got for $492,000. Within 2 years, we sold this for $1.7 million. Bought it for $500,000, sold it for $1.7 million 2 years later. I can't say that every single deal goes this fast or creates that much profit, but I can say this: we do really, really well with our properties. Steve mentioned earlier that we're 92% occupant across the board on all the properties that we manage. We manage these things in-house. We are a well-oiled machine. We're very dialed in. So if that sounds interesting to you, if you want to explore it, just know that Pine Tree Path, the property we're talking about today, it's more than half full. It's getting closer to the 2/3 mark. We suspect that we'll fill that one up in the next couple of weeks. So if that's interesting to you, then just reach out to us. Use the call link or use the booking link in the chat. If you're following us on Facebook or one of the other social platforms, if you're looking for a spot to book a call, just use the comments and type the word book, and then we'll reach out to you with a link.
We'll reach out to you. We're happy to share the executive summary / offering memorandum with you as well. That's the document that Nate was putting up on the screen. That kind of highlights all the different pieces of the property and the returns. So we'd be happy to share that with you and walk through that. That's going to do it for today's show, guys. It is always a great day to hang out with you here. It's always great to see you guys. JW, I see you on here. Chris Lavin. Chris is not hanging out on the beach today, which is so strange. We always see Chris on the beach. Said he's on the phone. Ralph is back in his car, zooming. Ralph, be careful out there. Guys, it is awesome to spend Tuesdays with you. If we can ever help you out in any way, either post in the Facebook group or book a call with myself or Sue, we're happy to help you be great stewards of what God has given you following the Matthew 25 principle. Wish you guys a great week, and we'll see you back here next week on Tuesday, where we share the news that helps you become great investors. See you all soon.
Bye, guys.